Food delivery is a simple business. While the market today is dominated by DoorDash, Uber Eats, Delivery Hero, and a few others, back in 2014, food delivery and the gig economy were just emerging in Silicon Valley. Back then, the barriers to entry were so low that anyone could open up their own food delivery business in a matter of weeks with just a few $1,000s and a website. Food delivery seemed like such a simple and obvious $1 million idea that as a starry-eyed 20-year-old at the time, I left college to start a food delivery company, joining many others in the gold rush. The market in 2014 was wide open for the taking. DoorDash had not yet become a household name, Uber Eats was just spinning up, and Grubhub was primarily used for looking up restaurant menus online. Food delivery is a marketplace business. On the supply side are the restaurants. What dishes and cuisines do you offer? Are they fast food, chains, mom and pops, bakeries, dessert shops, cafes, or fine dining? The more diverse, the greater, the more reputable, and the more exclusive your restaurants are, the stronger the supply of your marketplace. Back in 2014, not many restaurant owners were thrilled with the idea of entrusting food delivery to a pair of 20-year-olds. We quickly realized that to deliver for big players like McDonald's or the Cheesecake Factory, you needed the capital and the connections, neither of which we had. But most of all, you need order volume. Consumers are the demand side of your marketplace. The number, amount, and frequency in which they order determine your overall order volume. There are 3 ways to win consumers in the world of food delivery. 1, you can compete on speed. In order to be the fastest to deliver food, you need lots of drivers on the road, and you're making a bet that you can assign pickups, route deliveries, and pay out higher earnings to drivers more efficiently than your competition. You're also betting that consumers are willing to pay the highest premium for guaranteed convenience. 2, you can compete on price. By undercutting the competition as the cheapest delivery in town, or maybe it's free delivery, you're betting that the greater order volume over time will make up for all the loss that you're swallowing on every order. 3, you can compete on supply. If you can become the exclusive delivery partner for McDonald's and other big restaurants, then customers will have no other choice but to order from your marketplace, no matter how expensive or slow your actual delivery service might be. Today's giants like DoorDash, Uber Eats, and Delivery Hero all have the economical, technical, and operational means to balance between speed, price, and supply. But the barriers for entry continue to remain low, with new food delivery startups seemingly popping up every year. But these new startups simply can't afford to compete on speed or price. No investor or board member would approve the significant operational risk and cash burn involved with going head-to-head with Uber or DoorDash. As a result, these startups tend to specialize on supply. They try to monopolize delivery for a specific restaurant type, like Chinese or fine dining, but these niches are generally too narrow to sustain over time. If you don't have enough customers, you won't have sufficient order volume. If you don't have sufficient order volume, then restaurants won't partner with you for delivery. If you don't have restaurants on your marketplace, then you won't have customers. This balancing act between supply and demand is the fundamental chicken or the egg dilemma that all food delivery businesses grapple with. For each additional restaurant you bring onto your marketplace, you improve supply and demand with greater diversity and consumer choice. But there are downsides. The more restaurants that you bring on, the greater variance in orders, and the more diluted the average restaurant sales and returns become. There are also diminishing returns with scale. When consumers are given too many options to choose from, then browsing and ordering delivery can become overwhelming and exhausting. When your marketplace on the supply side scales to hundreds of restaurants, then discovery becomes a challenge as it's impossible for the restaurants that are buried at the bottom of the list to stand out to customers. And if those restaurant owners feel like their returns aren't good enough, they may choose to leave your marketplace and sign on with a different delivery competitor who can offer them better order volume, reach, and terms. Here's how we approached this problem back in 2014 as 2 naive 20-year-olds. VC-backed players like DoorDash and Uber were opening up their war chests to recruit as many drivers as possible through relentless job postings and sign-on bonuses that we could never match. For our startup, competing on speed was out of the question. Without restaurants, we couldn't pull in customers. Since we didn't have customers, we couldn't pull in restaurants. For the few restaurants that were interested in working with us, it was meaningless to bring them on since they were already offering delivery on Postmates, DoorDash, and Uber Eats. Our strategy was to specialize in supply by exclusively targeting food trucks, street vendors, and food stands, mobile food businesses who generally had more unique foods and had been neglected by the existing delivery apps for not having dedicated brick and mortar locations. Since mobile food vendors are transient businesses with very weak online presence beyond Instagram, we really focused on centralizing the experience. The goal was to provide consumers with one curated menu of multiple cuisines that were made up of the best dishes from credible vendors that we had vetted as a delivery company. This meant that customers could combine dishes from multiple vendors into one order. They weren't locked into ordering delivery from one vendor at a time. Before any vendor could sell on our marketplace, we would take the time to painstakingly work with the owners to figure out what specific dishes they had were worth selling. To ensure quality and prevent menu bloat, no vendor was allowed to sell every item on their menu. For these mobile food vendors, e-commerce, enabling customers to place orders online, paying with a credit card, having a website, offering delivery were all new ways to expand their business that they never had done before. They were really excited to work with us as a delivery company who would take professional photos of their food, handle their website and e-commerce, do the credit card processing, do all the online marketing, and then handle the last mile delivery for free. In exchange, we would take 30% and they would keep 70% of net sales. Since many of these mobile food businesses had no reputation and needed to build up their credibility, we leveraged price to pull in customers by offering free delivery and satisfaction guarantees on all orders. This heavy-handed, strict curation approach that we took was really labor-intensive. It would take us anywhere from 10 to 15 hours to onboard a single vendor onto our marketplace, but we stubbornly believed that our relentless focus on quality would pay off long-term. But after operating for a year, we ultimately concluded that there was really no way to make money from delivery. In 7 months, we had delivered over 3,400 orders and grossed over $35,000 off an initial bootstrap budget of $2,500. For two 20-year-olds, this was great, but in reality, the margins were never sufficient enough for us to pay ourselves or hire a single person. We were doing everything by ourselves, from taking photos of the food to handing out flyers and giving out samples, to packing orders at 4 a.m. and delivering to customers in our own cars. During the day, we would do marketing to try to build up demand, and into the night, we would work on supply, push website updates, and process orders. On the supply side, retention was difficult with inconsistent order volume. Our vendors would unleash their frustrations on us whenever they felt like they weren't making enough sales and threatened to quit. And some actually would. They would make all the hours that we had spent curating their food and taking photos a total waste. The other issue was that there were only so many mobile food businesses in our area. At one point, we had onboarded every single possible supplier to our marketplace within 75 miles of each direction. And whenever our menu became stale and we didn't have new vendors or dishes to offer, consumers would get bored and stop ordering. Caught in between the supply and demand of our marketplace to the point where our own friendship had completely deteriorated, it was a no-brainer for us to shut down our startup. With food delivery, it's really easy to get cash flow and momentum and get started, but it's impossible to make money and profit. To sustain, you need a ridiculously high burn rate that pulls in customers and generates enough order volumes to keep your suppliers and drivers happy. Fundraising from investors would just be robbing Peter to pay Paul. Having millions of dollars in a bank doesn't change the reality that you only make a couple cents on every order. 6 years after our startup, it's been interesting to see the continued hype of food delivery companies around the world, even though everyone seems to know that the unit economics just don't work. When you have to rely on tips to pay a livable wage to drivers, it's obvious that there's something fundamentally broken with the business model. If none of them could make money during this once-in-a-lifetime global pandemic, how could any of them turn a profit in this new environment where gas is going up, inflation is rising, and a recession is materializing? In this episode, we're going to look at the 4 biggest food delivery companies around the world: DoorDash, Uber Eats, Delivery Hero, and Just Eat. What are the strategies that these companies believe will lead them to profitability? And are these just fantasies that they spin for investors? And which companies have made the most progress? The current industry leader is DoorDash, who holds the highest valuation and the largest share of the food delivery market in the United States. The company's vision is that if they can build logistics and delivery to deliver ice cream before it melts, or pizza before it gets cold, or groceries within an hour, then DoorDash can become the on-demand delivery provider for everything, including clothes and medicine. This same ambition is rooted in the design of DashPass, which is DoorDash's membership program where customers can pay a flat monthly fee of $9.99 for unlimited free deliveries and lower service fees from eligible restaurants. Over time, DoorDash's leaders are hopeful that they can turn DashPass into a quote-unquote wallet for the physical world, where consumers can get delivery and special perks from not just restaurants, but all the other local businesses in their community, whether they're shopping in the store or lying on their couch at home. DoorDash's rise to the top has been fueled by its strategy of winning suburban markets and small metropolitan areas. While food delivery is the most visible in large, dense cities like Manhattan, Chicago, and Los Angeles, DoorDash always focused on the smaller markets that had been traditionally underserved. Suburban and small metropolitan consumers have fewer options when it comes to delivery, which meant that DoorDash could win meaningful customers at manageable acquisition costs. As annoying as it is for people in New York City to suffer on packed subway cars during rush hour, the reality is that the distance that big city dwellers travel is still significantly shorter than the many miles that suburban residents have to drive in their cars to buy a single thing. In addition, suburban consumers tend to be more families and less individuals, which results in larger order sizes and higher spend. The lighter traffic and easier parking in suburbs and small metro areas also benefits drivers who can do pickup and delivery more efficiently than in the cities where they have to do double parking in bike lanes and fire lanes. When it comes to driver earnings, DoorDash makes no attempt to hide that the tip is the most significant element to making its economics work. The current pay model for DoorDash drivers is made up of 3 elements. The first is the base pay, which is calculated based on the estimated time, distance, and desirability of the order. The second is the tip from consumers, which drivers get to keep 100% of. The third is promotions, where if drivers meet certain goals and conditions, then they can get a bonus payout for completing that order. But these promotions are generally too non-transparent and too inconsistent to be considered part of a driver's regular earnings. Not every driver is offered promotions, and the conditions to achieve such bonuses can vary for each driver depending on when they started using DoorDash, what sign-up codes they may have used, and what region they're in. If we look at the pay model for DoorDash drivers, the base pay is really the only stable element that DoorDash pays out. The tip is entirely funded and contributed and set by the customer. Let's look at DoorDash's own breakdown of an example delivery and see how much is given to the restaurant, how much is kept by DoorDash as the middleman, and how much is given to the driver. For a sample $33 order, of which food costs $22, service fees make up $6, taxes $2, and the customer adds a $3 tip. The driver earns $8, the restaurant gets $20, and the DoorDash pockets $5. In DoorDash's own example, the customer tip makes up almost 50% of the driver's earnings. Tipping is so central to DoorDash's economics that the company itself calls out the risks that if customers consistently provide low tips or simply just don't tip at all, then there would be a material harm in the company's ability to provide delivery and retain drivers. Earning on base pay alone is inadequate, but rather than directly educating or requiring customers to tip, DoorDash opts for this hands-off approach, and they let drivers and consumers socialize amongst themselves on how to be successful in its marketplace. This dog-eat-dog mentality is most visible in the DoorDash communities where seasoned dashers shame no-tip customers and fellow drivers who take no-tip orders. New DoorDash customers who assume that tipping is optional or don't understand how significant the tip is end up learning the hard way why their food never gets delivered. To put into perspective just how favorable COVID has been for food delivery, DoorDash's annual revenue grew at an astounding 1,580% in the past 3 years. In 2018, DoorDash was grossing $290 million in overall revenue with 83 million orders placed. Fast forward to 2019, DoorDash had grown 200% to $890 million on 263 million orders and 18 million monthly active users. At the height of the pandemic in 2020, DoorDash grew another 200% to a record $2.8 billion in revenue on 816 million orders and 20 million monthly active users. In 2021, DoorDash's top line increased by another $2 billion to hit $4.8 billion on 1.3 billion orders and 25 million monthly active users. Despite this historic growth, DoorDash continues to post a loss of $500 million every year with an average negative operating margin of minus 42%. While DoorDash can't escape the losses under traditional business accounting, the company pushes a set of operational metrics that it believes more accurately capture how profitability for them is just right around the corner. The first operational metric they have is called Marketplace Gross Order Value, or Marketplace GOV, which is simply the total amount that users pay on DoorDash. It combines the cost of food, taxes, tips, service fees, membership fees, Dash Pass fees of all the DoorDash orders that were placed that year. Marketplace gross order value is the closest public metric to order volume. DoorDash's revenue itself is just a slice of the marketplace GOV. It's made up of the 15 to 30% commission that it charges restaurants and the service fee that it charges customers. The rest of the marketplace GOV pie is paid out to restaurants and drivers. In 2018, marketplace GOV was $2.8 billion, with $290 million of that pie being DoorDash revenue. In 2019, marketplace GOV had grown 4 times to $8 billion, with $890 million of that being revenue. In 2020, GOV had grown to $24 billion, with $2.8 billion of that pie being DoorDash revenue. And finally, in 2021, GOV hit $42 billion, with $4.8 billion of that pie being DoorDash's revenue. DoorDash's second operational metric is called net revenue margin, or take rate, which is the percentage of gross order value the company can pocket as its own revenue. The question that this metric asks is that as the total amount of money that people spend on DoorDash's marketplace increases, as this overall GOV pie grows every year, is DoorDash able to take a bigger slice for themselves? There are several reasons why this metric is so significant. One is that it determines DoorDash's elasticity as a middleman. Delivery itself is a commoditized service. There's really nothing particularly special about how DoorDash delivers or charges its customers or restaurants. If DoorDash increased its restaurant commissions and decreased the amount it pays out to restaurants to pocket more of this pie for itself, how many restaurants would leave its marketplace? If DoorDash increased the service fees that it charges customers, how many of these customers would leave in favor of a cheaper competitor? If DoorDash decreased the amount it pays out to drivers, if it removed promotions or started taking a portion of the tips or they reduced base pay even more, how many drivers would still stay on a DoorDash? An increasing net revenue margin or take rate would suggest that DoorDash is building the loyalty, leverage, and strength with its restaurants, drivers, and consumers to demand a bigger slice of the pie for itself. But the results indicate that it's not really there. In 2018, DoorDash took 10.35% of the pie for itself. In 2019, the company slowly increased its take rate to 11%, in 2020 to 11.7%, and then in 2021 slightly back down to 11.65%. There's something clearly very fragile about DoorDash even during this rocket ship growth, where the company continues to be extremely cautious about upsetting the balance on its marketplace between the price-sensitive customers, the commission-sensitive restaurants, and the earnings-sensitive drivers. If you know you're not getting another pandemic with guaranteed growth where customers are compelled to use your service, yet you still aren't comfortable demanding a bigger slice as a middleman, at what time could you actually do so? The last operational metric that DoorDash pushes is contribution margin. Contribution margin is simply the money left when you deduct all the direct expenses, all the direct sales, marketing, delivery, payment processing, insurance, customer support, platform operations, all the direct expenses involved in generating and fulfilling orders on DoorDash. To play through DoorDash's logic, the company's contribution margin had been negative 20% in 2018 and 2019. That means that for every $10 order that was placed on DoorDash, the company was losing $2 at least gross on every order for those years. In 2020 onwards, contribution margin turned green, meaning DoorDash had finally achieved positive unit economics. That means now for every $10 order, DoorDash grosses $2.22. But contribution margin doesn't include R&D or G&A, which are critical expenses and strategic investments that can't be ignored. DoorDash calls itself a tech company and prides itself on building proprietary technology to enable operational efficiency above its competitors. If we include R&D and G&A expenses, which combined make up over $1 billion worth of expenses every year, then we arrive at DoorDash's net losses of $500 million. Could DoorDash's technology really reach a point of maturity where drivers and deliveries are so optimized that a high enough contribution margin could offset these billion-dollar investments? Or maybe try this angle. If you have to spend $500 million on software and R&D every year just to squeeze out a higher gross margin of literally $1 to $3 more on every delivery order, is that investment really worth it? Even if contribution margin one day reaches 50%, how many more orders and customers do you need to turn a profit when you're already at 25 million monthly active users and 1.3 billion orders in the US? DoorDash's leaders have been consistent in that they want to get the unit economics right in America before scaling and expanding internationally. When it comes to the labor pool, the company seems to favor having a large, replaceable, flexible pool of on-demand drivers that jump in whenever they want, rather than a growing, committed, dedicated, reliable group of drivers. DoorDash executives proudly highlighted that in 2021, even though there were 6 million Dashers that year, all these drivers worked on average less than 4 active hours per week. Of course, there's some nuance here in that active hours is actually the time spent from when a driver accepts to completes an order. The time that a DoorDash driver spends waiting for orders to come in can actually be much longer. DoorDash believes that acquiring drivers isn't difficult, and they believe that Dashers are an entirely different type of gig workers than Uber drivers, Instacart shoppers, or Lyft drivers. With DoorDash, you can deliver orders on scooter, bike, or car, and the company believes that this quote-unquote safer working experience allows them to bring on a unique audience of drivers and bikers who aren't contested or interested in using other gig economy apps. Despite the positive contribution margins of the past 2 years, DoorDash leadership pushes that the path to profitability is not really in growing margins point by point, but actually in generating higher order frequency. While the company acknowledges that there's still lots of areas to optimize for its drivers, like they can give better predictions on when the kitchen will finish cooking, so that reduces the time that a Dasher has to spend waiting at a restaurant for the food to be ready, I still think DoorDash realizes that these remaining inefficiencies are generally speaking too complex and expensive to rabbit hole into the pursuit of saving a couple cents. I sense DoorDash also recognizes that there's also little that they can do to influence order sizes at this point of maturity, but there's still a lot that they can do to influence frequency. Driving adoption and penetration of DashPass amongst DoorDash users is the company's biggest current focus. With DashPass, the company is making the trade-off to accept lower unit margins in exchange for higher order frequency. So while DoorDash makes less money on DashPass orders, but if DashPass can unlock a higher order frequency and eventually greater cumulative spend from its customers, then that's profitability. DashPass reminds me of Costco, where membership fees only make up 2% of the company's overall revenue. But those membership fees does wonders in encouraging customers to spend large orders at a regular frequency, which then drives up Costco's overall order volume and top line, despite having very minimal markup on each item. Newer DoorDash initiatives like DashMart further reinforce the company's goal of achieving high order frequency to reach profitability. DashMart is a relatively new rollout, which brings an inventory of grocery and convenience store essentials into geographies where such stores didn't physically exist or have 24/7 hours of operations. However, the latest economic conditions continue to expose the underlying fragile nature of all food delivery marketplaces when it comes to price elasticity. To offset the rise of gas prices, DoorDash recently rolled out 2 programs for driver retention. One was a 10% cashback on fuel expenses, and the other paid out a bonus if the driver drove over a certain distance. For both of these programs, DoorDash chose to absorb these programs entirely rather than pass on these costs to the consumers in order to preserve order volume and growth. To quote, "If we keep the consumer prices unchanged, and if we ensure Dasher earnings are preserved, that enables us to maximize growth because having adequate supply ensures that the customer quality is preserved, which then drives the growth flywheel. But with inflation, higher gas prices, and a recession coming, it's impossible to keep consumer prices unchanged. Even if DoorDash doesn't increase its service fees, the restaurants will inevitably increase the prices on their platform to offset their higher ingredient and labor costs. And if DoorDash increases its cut of the pie, the restaurant will more likely than not just pass those costs on to the customer. When we look at other food delivery companies around the world like Uber Eats, Delivery Hero, and Just Eat, we see the same story but with slight differences. Despite all of them enjoying rocket ship growth during the pandemic, none of these companies have come close to turning a profit. Uber Eats is probably the most amusing one. Buried deep in their financials, you'll find this horrifying line. Quote, "Cumulative payments to drivers for Uber Eats deliveries historically have exceeded the cumulative delivery fees paid by customers," end quote. This is Uber admitting that the service and delivery fees that they charge customers for Uber Eats orders has never been enough to offset the costs of delivery. Uber Eats from 2018 to 2021 grew from $1.4 billion to $8.3 billion in revenue, which is much higher than that of DoorDash, and that's largely thanks to Uber's greater international presence. As a result, Uber Eats marketplace GOV is much higher than that of DoorDash, with $51.6 billion for the most recent year. Despite burning money on every Eats delivery with a negative 2% contribution margin, Uber offsets the per order loss by demanding a much greater slice of the pie from its restaurants with a 16% take rate. That's 5% more than DoorDash. Delivery Hero also enjoyed spectacular growth during the pandemic in Europe, going from 687 million euros in 2018 to 5.8 billion euros in 2021, but still ended up netting annual losses of 1 billion euros. Thankfully, in Europe and Asia, tipping is not the same cultural or business requirement like it is in the United States. With stricter labor laws, Delivery Hero employs its own drivers and hires additional drivers through agencies. However, despite the company's impressive international presence and scale, Delivery Hero is doing the worst of all when it comes to margins. Even with 20% of the pie, Delivery Hero is still losing 14 to 20% gross on every order with no light at the end of the tunnel. Its fellow European competitor, the Netherlands-based Just Eat, seems to be in the same boat. When Just Eat grew from 2.7 billion euros to 5.3 billion euros from 2018 to 2021, largely thanks to its acquisition of Grubhub, the company has still continued to post annual losses of 200 to 300 million euros. The only time that the company has been able to not lose money on every order was when they hiked their take rate during the pandemic, taking a record 30% slice of the pie from its restaurants. Now that the pandemic is ending, Just Eat has been forced to lower its take rate to a more tolerable 19% of the pie, but the company has then swiftly returned to negative contribution margins and is now losing 7% gross on every order. It's no surprise that its investors are now revolting. They're calling for Just Eat's CFO and board to be fired in an open letter for quote-unquote torpedoing the company's future amidst a 75% drop in market valuation. When I see the payouts for the CEOs of some of these unprofitable food delivery companies, I can't help but wonder what could have been in a different universe had we stuck to our startup and joined the parade. But ultimately, if a company has to spend hundreds of millions every year just to squeeze one more dollar of profit out of a $10 transaction, or rely on consumer tips to pay drivers a livable wage, I think there's a good case to be made that perhaps that business just isn't worth it. Profitable food delivery is a myth, and value creation is meaningless without sufficient value capture.